Congratulations! You've made it to Module 3 of Women in Finance. For the first chapter, let's begin with the fundamental goals of investing. It's really important to distinguish between the common misconceptions of investing and the reality. Investing is not a game of chance or a shortcut to wealth. It is a strategic move to protect your savings from inflation, create primary or secondary streams of income, shield against losses, and create a robust financial foundation for future expenditures or retirement. It is crucial to remember, investing is not a game and it is certainly not gambling. It's a way to manage your money, not play with it. And with that said, let's dive into Chapter 2, Managing Your Spending. Managing your spending is a crucial step before diving into the world of investments. The 50-20-30 rule is a popular budgeting strategy where 50% of your income is allocated to necessities, 30% is allocated to non-essentials, and the remaining 20% goes to your savings. You can start by tracking your daily and monthly expenses, categorizing them into needs and wants. You can do this manually or use apps like Hisab Kitab to automate the process. As a general rule, focus on reducing high-interest debt and maintaining an emergency fund as insurance against future unexpected expenses. Monthly savings will give you the pool of capital that is required to begin your investment journey. And it will pave the way for what we call rupee cost hedging. Rupee cost hedging allows you to average out the buying price of an asset and smooth out the impact from short-term market volatility. As we discussed in previous lessons, there are a variety of asset classes that you can invest in, from low-risk government bonds, real estate, gold, foreign exchange, stocks, and mutual funds. A good portfolio will have all of these assets in a diversified way. And with that covered, let's dive into Chapter 3, where we discuss the dynamics of investing in the stock market. As we discussed earlier, a stock represents ownership in a company, giving the shareholder profits and voting rights. Stock prices move due to one main reason: demand and supply between buyers and sellers. If more buyers are willing to bid higher, stocks will go up. But if more sellers prevail, stocks will go down. The behavior of these buyers and sellers is influenced by two main factors. The first is the potential profits that a company will make. The company will give a portion of its profits directly to its shareholder. This is called a dividend. If a company is expected to announce a higher dividend, or in other words, higher profits, then people will be most likely be willing to pay a higher price because they will be expecting a higher cash dividend. This also works in the reverse. The second factor influencing the behavior of buyers and sellers is investor sentiment. If the expectations about the future of a country, its economy, and consequently the potential profits of a company are positive and improving, the stocks will go up. However, if it is expected that the economy will deteriorate, there will be more sellers in the market because people will be wanting to get out. Because of these variables, stock prices tend to be volatile in the short run, and valuing a stock requires forecasting whether the potential profits of a company will increase, while also looking at investor sentiments. So there you have it. This was your introduction into the fundamental goals of investing, how to manage your money, and the dynamics of investing in the stock market. Until the next lesson, happy investing!